talk about really in this environment, alternative. Okay, we're going to talk about real estate alternative. I had a slide deck prepared. I have a little bit of a problem getting it up and going here, so I'll just talk from it. I'm going to really turn this over to our panelists, who are all mostly family office investors, except for one of the Mintz lawyers here who has a lot of experience in alternative real estate as well. Before I do, just going to give a quick overview. So most people that invest in real estate invest in sort of 5 major sectors, which when you think real estate, you think of multifamily, office, retail, industrial, or hotels. But there's a lot more, and these would be the alternatives. And I'll just name a few. I've got probably 20 something listed here, but you got data centers, self-storage, home builders, single family rentals, CMBS, brokerage services, billboards, timber, medical, prop tech, fintech, manufactured homes, and go on. And these are sectors that are not the major food groups, but they're pretty active and places maybe to look at given today's environment. Just a quick introduction to some of our panelists. I'm just going to point to them. We got Josh Roach on the end with Meritage Group. They'll give you an overview of what they do when I turn this over. Billy Haddad on the other end with Partners Path. Jiho Lee with Tishman Capital Partners, and Jeffrey Moerdler with Mintz, our host here. So when we look at the market today, someone used the term chaos in one of the previous panels, and I think chaos is a good term to apply to real estate right now. It's like, if you're in real estate, what do? You want to buy, you want to sell, you want to do nothing? Can you get your deals financed? How bad is it? And the answer to that, it really depends on what part of the real estate food group that you're in terms of how bad is it. It ranges from very bad to not so bad. Obviously there are a lot of scary headlines that you read in the papers or online every day. Commercial real estate values keep sliding, down 15% from last year. Special servicing rates see the biggest jump since August 2020. Blackstone takes a $47 million loss on the sale of office towers in California. Their companies giving back, office in particular has gotten hit hard, we know, particularly Class B office. Blackstone's B REIT, the latest round, they had $4.5 billion of redemption requests. They fulfilled only $666 million of that, about 15%. Everybody else is kind of stuck in. So I can go on. There are more and more headlines like that, but not everything is negative. In Manhattan, apartment rents are at record highs, and there are bidding wars again to buy properties. Blackstone, while they have problems with their B REIT, they just closed on a $30 billion new real estate fund just last week. Goldman Sachs is out disagreeing with other bank lenders and saying now's not the time to panic about commercial real estate. So while debt is constrained, there's still a lot of capital looking to invest in properties. The last thing I'll mention before turning this over is, there was I got in my inbox yesterday about an office building acquisition from another company that was promoting they're buying a $90 million office property in Texas and touting why it was a good investment and that they're buying it from an institution at what they felt was attractive prices. So the news is really mixed. These gentlemen on the panel are going to tell you, where they're investing that are good places to invest outside of, the areas that are most troubled. And I'm sure it'll be an interesting discussion. So who wants to go first? Oh, and one other thing, is Camille still in here?
I am here.
Okay, Camille, everybody in the panel needs to know that don't say that you're investing in multifamily. Camille is going to leave if you do. It says
Alternatives, no multifamily.
Alternatives, no multifamily. So with that, Josh, I'll turn it over to you first. Tell us who you are and what you're doing.
Okay, great. Josh Roach with Meritage Group. I work with a family, Jim and Nat Simon's family. Jim Simons was the founder of Renaissance Technologies. Can you all hear me okay?
Yes. Yeah.
Okay. And just feedback from the machine over there. And this is a single family office vehicle for the Simons family, Jim and Nat. Nat is Jim's son. We have an office in New York, Greenwich, Connecticut, and California. And we're largely a direct investment house. So we've got about 50 employees in the firm, 25 investment folks, 25 back office, and we run 5 asset classes. One of them is in real estate, and happy to talk to you about what we're doing in real estate. I think the most interesting, well, I'll just touch on it. We can come back later. We see a lot of motion in our real estate strategies today, kind of our top 2, and one is wireless infrastructure and so cell phone tower strategies. We have about 500 assets across the country. Really interesting asset class. It's highly fragmented. Opportunity to kind of roll those assets up, and then you build wireless portfolios from them, and then you sell them off to, if you want to, you keep the cash flows, or if you want to monetize the portfolio, you sell it off to the large REITs or others. That's a really interesting strategy. It's a low capex, high cash flow type businesses. It's a big data play. So all those kind of the big macro directionalities are kind of in our favor in that way. So we work with a team that's exclusive to us, and we have about a 25-person originations team that goes out there and builds these portfolios and build these assets one off. That's been interesting. We've done that for a little over 5 years. It's a pretty interesting strategy that's alternative to everything else that's going on. The other interesting sub-strategy is manufactured housing and RV parks. So we're doing Class A product in Texas. I think we've got about 12,000 units of that, and that's also pretty interesting. It's a really interesting asset class, right? Because it's very hard to get permitted. No one wants one of these in their backyard, and there's no place to go at that level of housing. You kind of have to, you're there, so it's very sticky. You know, the model is you build these lots out, and the owners or the home buyer brings their own home or brings the sticks and bricks to your lot, and so you rent them out that lot. So it's pretty interesting. Again, it's a low capex, high cash flow model. Limited opportunity to grow that business kind of opportunistically. You really have to have great relationships in the municipalities you're in, but it's a phenomenal kind of very durable cash flow strategy that, of course, doesn't see the issues that you have in metro markets with office and those types of things. So I'll pause there. We have 3 other real estate strategies that a lot of other people have as well, but those are probably the 2 most interesting that are just kind of moving forward at good pace with us.
Now, for those that want to consider investments in those areas, how are you getting involved in them? How would people get engaged in those businesses?
Well, historically, we don't take third-party capital on, although for the wireless strategy, we'll entertain a couple of partners today to come in with us. We already have a significant portfolio. We're looking to grow that a little bit further. So we'll entertain 3 or 4 other partners to come on that. Everything else is generally kind of, we don't take on third-party capital.
Jiho, I see you shaking your head to virtually everything that Josh said. Are you guys doing similar things?
Yeah, so quick intro. My name is Jiho Lee. I'm with the Tishman real estate family of New York. You know, this is actually our 125th year anniversary. So we've traditionally had a real estate operating business ourselves where we've been focused mostly on hotels, office, and retail. But as we kind of get into this more volatile time period, we're really focused on thinking about, you know, how do we survive this volatility, and not only survive, how do we thrive? And one of the key themes that we're really thinking about is, one is long-term durability, meaning because of the heightened volatility, our entry point, you know, will obviously impact our returns, but what are some asset classes that could be more durable where your entry point might not be as important as we accumulate portfolio? And the second aspect is really thinking about what are more durable cash flow as opposed to banking on appreciation. So I think Josh hit on a few of those points. One of the factors on the manufactured housing RV parks is a supply-demand imbalance. There's virtually no new supply. In fact, it's decreasing supply, which makes it interesting. For us, taking on that theme, we are looking hard on agricultural land. Specifically, we're looking at some citrus farming in Florida. You know, one of the special situations that happened was there was a disease that's been impacting a lot of these crops, citrus crops. And recently, one of the groups that we're close to have invented a cure for the citrus plants. So with that, we think there's a strategy that we can build on where we can not only have durable cash flow, but potentially an uncorrelated, economically uncorrelated asset class that could be healthy. So agricultural stuff is one thing we're looking at. Perhaps another thing that's counterintuitive that we're looking at is a mixed use, you know, live, work, play type of development in suburban kind of, you know, kind of high traffic suburban locations. The reason why I point that out is the capital markets for those type of assets have been really destroyed, and it may be very slow to recover, but the cash flow itself is very durable, is what we see. So we think there might be some kind of out of the box opportunities in areas like that.
Now, thanks, Jiho. What kind of returns, Josh, are you looking for manufactured housing or cell phone towers, and what kind of financing is available?
So they're high teen returns.
Leverage or cash on cash?
Yeah, we low leverage. We have a low leverage kind of profile, but you know, they can get up into the 20s. We haven't monetized those assets, but I think if you look into it, I mean, the public comps for selling cell phone towers are high 20s, mid 30s. So we try to build them, and we do build them much cheaper than that. You can build them one off. So you can apply your own leverage multiples you want on that, but you don't have to over lever them too much, but they do cash flow quite a bit. But you know, everything we do, we're looking for long-term durable cash flow streams. And so we don't set out to try to shoot the moon. The goal is to have a durable set of cash flows kind of in perpetuity across different asset classes. So we're okay with the mid-high teens, and if it gets up into the 20s, that's okay as well.
Now, public REITs, you know, you can find a REIT really for almost any strategy at this point. You know, there's certainly lots of office REITs which look like a train wreck, and some of the other sectors that are looking much better. And I know there are manufactured housing companies that are public, and cell phone tower companies that are public. Do you guys invest in any of the public vehicles, or is it all private deals?
So we invest in public positions, right? We run a long short portfolio, highly concentrated, super low beta. We don't invest in those public companies directly. So we understand them. We've looked at them. Obviously, having that knowledge internally is helpful. But we know them, but we don't invest in them today.
Okay, thanks. You guys have any questions you want to throw at them?
Have you explored, Josh, going beyond the wireless tower strategy into things like DAS, inbuilt wireless, or data centers or other stuff? Those are areas I'm very active in. So DAS is distributed antenna or in-building wireless systems. So the best example I can give is I represent Madison Square Garden for the last 20 years. Did all their cellular deals. They had 4 carriers with 4 separate equipment rooms and a morass of wiring and separate antennas in the garden. When they did the major renovation 8 years ago, we terminated all the carriers and we put in one shared network. So there's one equipment room. Carriers bring their signal into that equipment room. It's put through a combiner, one set of wiring, one set of antennas covering every inch of the building, whereas the prior carriers hadn't all covered the whole building. Do the same thing in an office building like this, in a hospital, in a residential building, in transportation facilities, shopping centers. In some contexts, the carriers will fund or reimburse for that, or pay a high lease rate to access it. But they won't for residential, they won't for smaller office buildings, and the owners have to fund it as an amenity or a fourth utility. So is that something you've looked at all?
No, we haven't. I think if you look at the history of the firm, we've evolved over time significantly. So we're deliberate and deliberative on what we do. We're typically fairly slow, but that's an adjacent area, obviously. And we're happy to look at things, particularly with partners on it. We haven't invested in that space today, focused really just on this roll-up strategy, probably another 5, 6, 7 years of that, and we'll see where we go from there.
You actually building the cell tower sites yourself, or are you acquiring them from others and rolling them up?
Right. So there's, you can buy the tower or build the tower. You can buy the ground lease. You can do both those, right? Or the towers on top of the buildings as well. So there's 3 or 4 different acquisition strategies and kind of micro revenue streams throughout every kind of tower. So we're doing a little bit of all of that. I would say the macro way to think about it is whether you're a building owner or you're a landowner, you have the opportunity to put a tower on your property if there's a market for that. And there's thousands of mom and pops that have these towers. Maybe they have 2, maybe they have 3. And the majority of the market is highly fragmented like that. And we just simply go out there and we know who owns those towers. We just roll them up. So it's kind of basic block and tackling of, sorry to ignore these folks over here, block and tackling of just finding these towers, negotiating deals with them, and roll them into a larger portfolio. And the idea is hopefully with bigger cash flows, you can get a larger multiple for your portfolio down the road. But as that industry in 5G kind of moves forward, I'm sure we'll be paying attention to those adjacent areas.
And there's a lot of opportunity with 5G also to add additional infrastructure.
So, we've certainly looked at a lot of those areas, including data centers. One of the reasons why we hadn't been focused on was going back to the durability. We're not as smart as, say, the tech forward teams to kind of know the functional obsolescence of data centers. We've seen markets like outside of Washington, D.C., some areas that have built a lot of data centers in the past 10, 15, 20 years, and now the co-hosting location, they're sitting vacant because of the functional obsolescence. We, as real estate people, we're not looking to pretend to know what we don't know. So we've been sort of avoiding some of those areas due to lack of knowledge more than anything.
I guess I can just jump in. Quick
Billy,
intro and
intro yourself. I'm gonna leave you out.
yeah. So Billy Haddad, I work at Partners Path. We're a family office that primarily invests in real estate. We have 2 main business lines. I'll go through the first one quickly because it involves multifamily, which is we own and operate our own portfolio of properties on the multifamily side. And then the other side of our business is a co-GP platform where we invest across the country throughout the capital stack alongside sponsors that are on the ground. And so I guess from the alternative perspective, I guess it's not that alternative, but we really moved into the credit space about 5 or 6 years ago. There's a pretty big hole in the market that banks have left since '08. So we've kind of stepped into that where we can get attractive leverage from banks, but sponsors can't get attractive leverage from banks. And so we can kind of take a nice spread there. It's not the most tax efficient structure, but it's been a safe port in what I think has been a storm for the last 5 or 6 years, at least from a deployment side. Other kind of alternative ones, we've looked into agriculture as well. I think it's gone okay. I think it's a situation where, especially as a New Yorker, you're the dumbest guy at the table when you get into agriculture. And so I think there's a learning curve there that you want to kind of dip the toe and build and find the right partners and not just kind of launch into it because there's a lot you don't know. But I also agree. I think it's funny to hear RV parks and manufactured housing because I think those have been for the last 10 years. I guess 10 years ago, it was kind of a very small, not often talked about. I think it kind of got popular, similar to car washes, as like a roll-up strategy. And I think now it's kind of hit the mainstream in a way where I think more and more people are looking at RV parks and manufactured housing. Biggest question mark on the manufactured housing side is largely management because it can kind of be in far-flung places. So you have to find the right person on the ground who's going to go collect rent, take care of things. And I think the other thing to watch on RV parks is coming out of the pandemic. I think you've had this period where people really went to RV parks in mass. And the question is, does that hold? I think it's kind of the opposite side of office, right? Since 2020, you've had people going to RV parks, buying RVs. It's become very popular. I think since 2020, you've had people not in the office. And the question is, how quickly do we revert back to 2019? Do we revert back to 2019? What's the new normal? And I guess it's not an alternative, but I think office is going to get oversold at some point in the next 18 months. And I want to be there to buy up that debt because I think there's going to be a lot of great opportunities because you're talking about kind of world-class locations that are trading at heavily distressed values. And I think most employers will go back at least 3 days a week. If you go back 3 days a week, everybody needs space. And that's an important threshold. I think people cut their square footage, but as you see at One Vanderbilt, for the right space, people are still willing to pay.
So I'll just add to that. My background, I'm a real estate lawyer for 40 plus years, did my first telecom deal in 1986 and spend half my time in the space. But also other alternative investments like healthcare, real estate, biotech, storage, self-storage, medical office, energy, sustainability stuff. But just to the point of going back to the office. So we moved into this space about 5 months ago, and we signed lease about a year and a quarter ago or a year and a half ago. We went counter market. We went from 78,000 square feet at 666 Third to 103,000 square feet here. But we changed because we were out of offices at the old space, and we went counter market also during COVID. Most law firms contracted. We brought in 45 lateral partners with business and are backfilling with the associates to support them now. Actually, depends when you call the end of COVID. We brought in 8 partners and opened a Toronto office last month. One of the interesting things we did differently in this office is we went to one uniform size office for every attorney. So I went from a 22-foot long, 3-window corner office in the old office space to the identical office that first and second year associates share an office. Third year associate has the same office I do with the same furniture. And it's just a question of how we decorate it, which gives us the flexibility to bring in and shoehorn into this space twice as many attorneys as we had in the old space, and to move people around flexibly for the future. So a little different decision in our space.
Question.
Sure. There's a quote from a very smart man. Humility is a really important thing. Anybody that doesn't have humility in this field is really right for a fall. That was from Howard Marks from Oaktree. Okay, very important this. One of the reasons why real estate got funny and great was low interest rates, leverage a lot of stuff, you ran it for 10 years, okay? And that's part of the problem. It's not going to change, efficient buildings and whatnot. But we turn around and say, okay, what's next? What's the next shoe to drop? There's $1.7 trillion of finance in 2025. Bass, one of the Bass family people, was in the paper over the weekend saying, you know what we got to do with real estate in many of the cities? Blow the goddamn thing up and rip them down. Okay, so part and parcel of the question is this a cyclical or secular issue in commercial real estate? What my friend Josh here is doing is picks and shovels. That's what makes sense. But commercial real estate writ large has got a long way to go. I'd be interested in everybody's opinion.
Well, let me start with a little bit on that. I mean, what I tried to paint at the beginning is that it's hard to paint all this with a broad brush. I mean, you're right, and that's part of the scary headlines that I was talking about, the $1.7 trillion of real estate debt. And the answer is we don't know. I mean, it could go either way. We don't know at this point. Certainly by now, a lot of people have predicted a lot more disruption by now than we've seen. And that hasn't come to, what's that?
40% down is what some people are saying.
Yeah,
Wow.
it hasn't come to pass yet. So it's unclear whether it will come to pass. I mean, we may go through another extend and pretend cycle.
Yep.
And certainly there are going to be loans that come due and are coming due where people are giving back the keys on properties. But there are others where the financing will be there, but the owners are going to have to come out of pocket
Absolutely.
or raise additional money and dilute themselves.
But I guess
There'll always be liberalizations of restrictions too on who the investors can be, as happened with the single family housing market in 2012, et cetera, right? So, I mean, there's all kinds of ways to address it.
well, I think what you're addressing there is one. I think you're in some ways painting with a very broad brush, right? So there's 1.7 trillion of commercial real estate, right, which takes on a lot of different faces, right? Like I think if you look back 40 years, people were saying it's the death of malls, right? And in large part, you think about suburban malls, they were kind of right? There's B and C malls that no one, you go on, there's Twitter accounts that post pictures of abandoned malls and what they look like today. But Simon has gone ahead and made tons of money, right? Revamping, like, and I grew up on Staten Island. The Staten Island Mall was one of your typical kind of BC suburban malls. Simon came in, invested a ton of money, changed it, and now they're making a lot of money doing that. And I think you're going to see that with office. There are office buildings in the United States that no one will ever work in ever again, right? But there are also office buildings that someone's going to come in, buy the debt, right? You said it's down 40%. If it's down 40%, okay, so if you levered it 55%, the equity is still worth something, right? So someone's still going to operate it. If it's down 60%, okay, someone goes and buys the debt, and now they have a low basis to do something with, right?
Smart investors count, and Simon is a better operator than any of the other people you just mentioned.
Well, I mean, in regards to malls, right? But 1.7 trillion is 3 asset class, right?
Absolutely, but I'm just suggesting differentiation in terms of the investment, where the CRE is, and some operators like Simon can live in malls because they're better operators. Other people cannot do that. They're full of buildings.
That's true of every asset class.
So I'll talk about
talking about the real estate right now. It's a secular problem.
So I'll try to answer. Yeah, the question was secular versus is it secular or cyclical? So part of Howard Marks's Sea Change article in December was talking about a secular shift in the low rate regime. The 40-year rate cut regime, at least for like my personal opinion, and a lot of my colleagues might share this, is that we think the low rate regime is not coming back anytime soon, at least from what we can see. So that marks as a secular change from our perspective, from a capital markets perspective. That's different from a little bit on the cash flow side, which is why we've been focused a lot more on durable cash flow as opposed to relying more on the capital markets. Talking about the mall, part of the secular shift of the mall is what has been the death of class or shrinking middle class. A lot of malls built in the 70s, 80s, and 90s were built in middle class locations. And so that's been, so we definitely see that trend from a secular versus cyclical. Certainly there are cyclical aspects that we were supposed to have gotten hit from a cycle perspective that we, the can got kicked down.
Real estate doesn't tell you the low interest rates doesn't let for secular versus cyclical.
So at least we're viewing it as there's a huge risk of that secular shift. Nobody's predicting it's one way or another. We're acknowledging that risk exists. That's why we're really trying to be prepared in looking at strong cash flow.
That's why Mark's right about having humility. And
we had a short duration, hedge fund guy, credit guy here, 4 months ago, and he was like, everybody says it's going to be bad in 6 to 12 months. Why only invest for 3 months? Right. So that's the question I'm answering. Right. So Howard Marks is not a real estate expert, right?
No, but he's one of the smartest guys out
there. So when the federal government says we got a problem, how do we resolve it? They go to the real estate experts, not the Howard Marks, who says blow it up, invest with me. Right? So keep on going.
Well, they go.
So to the blow it up comment, I analogize a lot of this to what happened after 9/11. Lower Manhattan was a wasteland. It was blocked off for months. You couldn't get a car south of Canal Street. Offices were closed. And what happened? There was some government incentives that were helpful. There was a redevelopment of the World Trade Center. But the biggest thing that changed down there is the 8 tenants that were quality tenants upgraded, moved into better buildings, be it the New World Trade Center, which I had the pleasure of being involved in the redevelopment of, or up to Midtown. The B tenants moved into the A space that had been vacated, and the C buildings got blown up in a sense. They were converted to residential or to hotel. I think that's what we're starting to see already. There have been a bunch of acquisitions in New York and elsewhere where office space is being converted to residential, to technology-oriented space, to all sorts of alternative uses. I read about an office building that was being converted to storage space. All sorts of stuff.
Sure.
But
creative.
It's got to be creative and rethinking the template.
I got to imagine there's a heavy geographic aspect to this also, because if I had CRE in Florida, Texas, or Southern California, that's going to be redirected into new home real estate, single family, multifamily, whatever, pretty quickly. So then the issue is with that segment, and then it's just a matter of what area parts of the country you're operating in. So,
yeah. I'd like to hear the comment from Tishman, the Tishman person, because Tishman has had an experience of office in New York City through various cycles, and I'm old enough to remember when office buildings in both downtown and midtown were empty, and then they came back. So, what are you really seeing? What is the scale? Because there's a lot of stories that try to scare you, and then there's a lot of people saying this is a great time to buy. What is the truth of the leasing situation, just in general the trends of people trying to either downsize, upsize, and you have I think in the Tishman portfolio you have A and B buildings, or what we consider the more desirable and somewhat less desirable buildings, or less modernized buildings.
Yeah, thank you for the question. So actually, the Tishman family I work with is the Tishman company. I think the Tishman that you're referencing is Tishman Spire, which has been mostly more the Spire side of the family. We come from the same roots. We've split up back in the late 70s. However, I can take the question, at least, one of the secular trends that, at least this is my personal observation / prediction, permanently weighted average lease terms in offices are shortened permanently. That's going to have massive impacts in office capital markets. If it hasn't already, people should realize it. That's as if bond duration has shortened. That's supply demand, regardless of supply and demand. The capital markets are permanently impacted by shortened weighted average lease term. If I asked the Mintz team here who signed this beautiful 100,000 square foot lease, my guess is your lease term was probably shorter than what it would have been. So
Our old lease our prior lease was a 12-year lease in a Tishman Spire building, and our lease here is a 15-year lease.
Right. Wow. So there are always exceptions to the rules.
Sorry, cheap.
Well, but there's a good point that you made in the first part of the question about the cyclicality, particularly in New York, as we've seen. I've been in the business now for more than 30 years. I won't say exactly how much, but I've been through. This is probably the fourth or fifth real estate crisis moment that we've had in that time, and up until now, and New York has always bounced back. Whether it will or how it will this time remains to be seen. As for Tishman, just interesting trivia note: this building, 919 3rd Avenue, was originally built by a predecessor company of Jiho's company, Tishman, that was a public company, Tishman Realty and Construction. And this is one of the first deals that I ever worked on as a professional in real estate. Was the company that I worked for at the time, Lazard Realty, had bought that building and a couple of others out of bankruptcy from Tishman in the late 70s, before I ever worked there. So don't blame me, Jiho. And this building, then I worked on a financing deal in the early 1980s here in this building. And this building alone went through cycles. And there was a time where this location was not as well favored as it is now. And there was even, I think, a foreclosure somewhere along the line in the history of this property. So it's a great example of how the ebbs and flows of real estate in New York and how things have come back over time.
But one of the key themes that everyone could probably agree on is flight to quality. And I think office sector is no exception to that. What it seems like a trend, can't say it's cyclical or secular. It probably depends on the time frame we're speaking about, but that trend is obvious. I think the 3rd Avenue corridor, for instance, will, it's to be seen how robust the leasing activities would be. We've definitely seen more activities around, the Grand Central corridor. Obviously, Hudson Yards have been, a sweet kind of like a positive spot in the market, but that's to be seen.
But I think the market adapts, right? So I think what you're seeing now is there's the flight to quality of the One Vanderbilts, the Hudson Yards, the New World Trade Building, right? And so now what had been the market clearing price on 3rd Avenue is just too high for where the demand is, right? And so you'll just have pricing will reset, and then you'll lure the Mintzes of the world to 919 3rd Avenue at a new price point. And I think for the buildings that potentially don't get filled, right, the city will do something to fill it, right? In the same way that we have 421A or any other tax abatement in any city, right? Which is effectively just the government saying it's not economic for you to do something we want you to do. So here, go do it, right? And you're seeing it with office buildings getting turned into all sorts of things that they may not have originally been zoned for. And so there's a move and there's a counter move, and you just have to try to stay ahead of what that next move is.
But I mean, as you lower the price point, you're lowering the cash flows, and the question, the $100 million question, or billion, whatever, is how much are the leverage those buildings have, and whether they can actually withstand that. I mean, are we going to see, just like yesterday, there was like 7 buildings that were, where the keys were given back by Brookfield in DC.
But the buildings don't go away.
No, I understand.
Right? Like, it's just a pricing reset.
As investors in real estate or in commercial mortgage securities, we get at the indirect impact. So the question is, how much is the existing leverage on commercial New York real estate? How high is it, and how sensitive is it to the new rate? I mean, Mintz did this deal 16 months, 17 months ago. If they were trying to do it today, would they get $10 cheaper, $10 a square foot cheaper, or 20, or?
I don't think we'd get a dime cheaper per square foot, because the face rate on the lease is being maintained at a high level. We'd get more incentives in a work letter for construction reimbursement or free rent period, maybe. I think it would be about the same now.
I mean, Marty, I have an easy question. So what's going to be the correction, and who are going to be the winners?
In what market?
CRE, New York, Boston, California.
So
Commercial? California all the time, and nobody that we have who are real estate investors invest in California. So, but I mean, because there were winners when all, the mortgage homes, federal home loan banks went under back into the 1990s, right? Some guys like Maxwell Reaver bought 70,000 apartment units, right? So they're
talking about commercial real estate, right? I mean, so these markets aren't monolithic, right?
Yeah.
So
so what's the opportunity, and what horse are you betting on?
So we didn't talk about another asset class we have is industrial and hospitality, and we own a good chunk in downtown Nashville, and we bought that like everyone else did at a time, and we were about to put something, go up from the street level up, and as a family office, we have duration on our side, so we just put it on pause. We don't have a artificial fund that we have to push things through. We've got a great opportunity there that when pricing comes back around and labor comes back around and inputs come back around, then we'll go up on it. And that's going to be a great market. And there's probably still a great market even today, right? That's probably going to be different. Nashville's going to be different clearly with a different outcome, likely than Chicago, I think.
At least I can speak to who will be the losers. Those who are forced to do mark to market in a period of volatility will be losers.
True. As well as those who are over leveraged, those commercial mortgages that are coming due, the trillions of dollars, the buildings that are at 50% leverage aren't going to have the problem that a building that's at 80% leverage with mezz debt on it above it, taking it up to 95%. That's dead in the water in almost any sector.
By the way, we have a great speaker tomorrow who's going to talk about the dollar carry trade, which is borrowing a dollar for 1% and getting 7% back in return. And he's like saying there's a big probability that's changing. You're not going to be able to get those cheap interest rates for a long time. And dollar carry trade has impacted real estate. I think you're saying 95% leverage. That's a lot.
Well, one of the things, and this transcends office. I don't want to keep this on just office, but one of the factors that we've had and why you haven't had the same level of disruption and distress is that many borrowers borrowed when rates were really low. So, they're still sitting on, their 3% mortgages or whatever. And that's true in, most commercial space areas. Even in the housing market, people said, why haven't housing prices corrected? And the reason is homeowners that have their 30-year mortgages at 3%, they don't have to sell. They can't move, but they can't sell. And the flip side is you have supply that's very constrained because there are no sellers. So the only people that are disadvantaged in that situation are the people who are renters and not homeowners because they can't get a mortgage. The mortgage is too expensive. The rents are still going up anyway. So, and their incomes aren't going up to match.
Hey, Marty, I got a last question, even more softball than yours, okay? Even more softball than yours. Okay? Let's hear it, Steve. Sure, here we go. Regional and smaller banks and commercial lending. 70% of the CREs are out there with regional and commercial banks. We're not talking about New York or Boston or Chicago or any of these ones we just round off. Those people have problems with interest rate risk. They also have problems with default risk. Think about it. That's a huge piece. And as interest rates change and as regulation comes in and gets pressure on small and mid-sized banks who own 70% of the mortgages out there, what's going to happen?
So first of all, I would love to actually, frankly, fact check some of the numbers.
At least here in Bloomberg. You want to fact check? It's right here on Bloomberg.
I can give you my Moody's article from SNL Financial, FDIC data. Out of the $4.5 trillion of commercial real estate debt that's outstanding, 39% is of all banks. Of the 39%, about 12% is large banks. So small and regional banks consist about 27, 28% of the total outstanding debt balance.
Really? And I guess you about fact check Bloomberg.
Yeah, it's from Howard Marks.
Oh, Dr. Marks.
I think actually, so part of that, and what's not mentioned there is how much recourse liability is actually there. So it's not just the outstanding loan balance, but how much of the credit support there that exists there. And we are of the belief that the credit standards, even since the last financial crisis, actually have tightened, probably about 5 to 10% loan to value. Certainly values have increased a lot, but when research firms like S&P, Moody's do these stress tests of regional banks, actually even on a 30, 40% value down scenarios, they're able to withstand with minimal loss. And that's to be seen. It might take more and it might come into play with certain banks getting hurt worse. I mean, even like Silicon Valley Bank and Signature Bank, their demise was not commercial real estate loans, as you know, it was their carry trade go wrong.
But that doesn't discount the positive outflows that are flowing out, and therefore there's additional burdens on it.
We got 2 minutes to answer.
Okay. I'll just have an adjacent comment to that because I don't have a macro perspective. Clearly, something's going to happen with the smaller regional banks. We're not doing this yet. We're looking at it. There's an opportunity in bank recapitalizations in some of these markets. And if you know bank recap experts, some of these smaller banks are not going to be able to move and take share because they've got these uncertainties. That allows better capitalized banks to go and take share. So not rescuing, although there's the strategy to go bank rescue, but you can recapitalize a really good bank in a small market and just grab share. And I would encourage people to take a look at that. We're not doing anything in that space yet, but it's piqued our interest.
Yeah, I think that it's a little overblown, the risk that exists, particularly from commercial real estate, just because if there's anything I've learned over the last, call it 4 or 5 years, is the amount of dry powder that continues to sit on the sidelines, quote unquote, waiting for this moment. And this moment still has not happened. And so I just think, you saw Blackstone raise that fund. Obviously, they have their BREIT issues aside. I think that even if people start to exit the market, there will be people swooping in to pick up the pieces. There's just no shortage. Like, obviously, with interest rates going up, there's less capital out there. But for the right opportunities, there will be capital. And I just don't foresee some kind of 08, 09. Obviously, I could be dead wrong and I'll look like an idiot a year from now. But if you look at the lending standards and the capital that's out there, I think people who own product right now will lose money. But that doesn't mean that everything falls apart.
So I think everybody here is going to be at dinner. Are you? No, almost everybody. So we can answer the remaining questions at dinner time.